Hello and welcome everyone out there. Thank you for joining us today to the Digital Talk COVID Impact 5 bonus for German real estate markets, powered by Colliers. To all of you who are joining us for the first time, my name is Julianne and it is my pleasure to be your moderator today. We're delighted that yet again we are able to welcome such a considerable number of participants and are looking forward to a very interesting session on the current macroeconomic developments in German real estate markets. While global markets are in general turmoil, it seems that the German real estate markets are consolidating their image as a safe haven for investments. The regional and polycentric structures in this country can be difficult to grasp and are very intricate in their organizational structures. It is therefore no surprise that this very setup has in the past been cause for discomfort among international investors. Interestingly enough, it could be precisely this setup which is now making the German markets incredibly desirable. Today, our guests shall address global economic developments and in how far the former are or aren't impeding on German growth, and which prospects the German real estate markets have to offer. It is therefore my pleasure to welcome our speakers, Mr. Professor Fratzscher, President at the DIW Berlin Institute of Economic Research, Mr. Hubert Joachim, Deputy CIO, Amundi Real Estate, and Mr. Ali Otmar, Senior Partner, Deputy Head of Investments at Tristan Capital Partners. And of course, our host, Matthias Leube, CEO at Colliers International Germany. Thank you all for taking the time and joining us on here for what promises to be a great discussion. Today is all about getting the right intelligence in order to make better investments and based on that, go forward with a strong portfolio. Finally, let me just briefly touch upon our schedule for the next hour. Mr. Fratzscher will start with a brief overview on the markets and then hand over the microphone to Mr. Leube, who will provide insight on the different asset classes in the top 7 cities. And in the following, they will discuss the market prospects with Mr. Joachim and Mr. Otmar and take their reflections on the current economic developments and investment opportunities. After 40 minutes, we will open the debate to everyone. And this is the time for your questions. Please do not hesitate to send them to me via the chat, and I will communicate your questions to the speakers accordingly. We have made a bit of a habit during the past weeks of having a very tight schedule, which is why I'm hurrying. So without further ado, Mr. Leube, the stage is yours.
Professor Fratzscher is starting.
All right, good afternoon. And first of all, thank you very much for having me. And I want to give a bit of an overview first of starting with the macro perspective, in particular taking perspective on what really has changed, what's new, what has been different from a few weeks ago. And then I want to move on to some sectoral issues, talk about how different sectors are affected. I want to talk a bit about the corporate exposure of non-financial companies, and then talk about policy responses. So let me get straight to the issue of where we are in the crisis. And I like this picture where to think of the crisis of 3 stages or 3 phases, and we're currently in the second one. So clearly containment is ending almost everywhere in Europe. Things are slowly opening up. We see travel restrictions have been lifted as of 15th of June. So we're clearly in this period where there's not a vaccine yet, not a treatment, but clearly a liberalizing and open up of the economy, though we don't know how long that phase will be, and we also don't know whether there will be a fall back into phase 1, whether there will be a second wave. And this is, I think, one of the big issues to look at. Now, the first change that to me over the last 2 to 3 weeks has become quite clear is that if you're talking about a recovery scenario, we're no longer talking about a V-shaped scenario. So early April, mid-April, a lot of people thought it will be a very deep drop, then a very quick recovery. And I think now there's a broad consensus the recovery will take some time. And here you see projections for world GDP. This is by the OECD. So with 2 scenarios, is what they call a single hit scenario. So closure in March, April, May 2020, and then an opening up and a gradual recovery. And then you have a second scenario, a double hit scenario, where in their case, by the end of the year, there would be a second wave, again with widespread closures in many countries, and a second dip, and then a recovery. But the clear message is, look, the recovery is not V-shaped. It will take a long period of time to take. Under the optimistic scenario, so no second wave, no financial crisis, no global trade conflicts, no country in the euro area or elsewhere getting into serious financial difficulties. We're talking about 2 years, 2.5 years to get back to where we were beginning of this year. If you take the second, the double hit scenario, we are talking about another year to 2 years. So we're talking about 3 or 4 years to reach the level of early 2020. So this is the two scenarios to be aware of. Quick chart on Germany. This is coming from our own projections here at DIW. We actually less optimistic on the recovery than many projections. So we see a contraction under the single hit scenario of close to 9% this year, and then a recovery of 3% next year. So, you know, we're talking about 2-year recovery. This compares somewhat different. These are now again the OECD numbers. World growth this year under the optimistic scenario -6%, then a recovery of 5.2% next year. If you look at the euro area, this looks a bit deeper and sharper, the contraction, 9.1% for this year under the optimistic scenario, 11.5% under the pessimistic scenario. So clearly you see that Germany, compared to other euro area countries, is weathering the crisis relatively well. That's an important message. I come back to that later on. There has been no government in the world having a bigger stabilization and fiscal stimulus than the German government. 2 weeks ago, it announced a big package. I come back to that later on. But clearly the message here is Germany is weathering the crisis relatively well, despite its openness and high dependence on exports, which have been hit particularly hard. Now, if you look at unemployment, I will skip over that very quickly. One of the great advantages in Europe has been strong social welfare states. So most of the pressure on the labor market has been absorbed through short-term work contracts or job retention programs that have absorbed unemployment or have made it possible for people to stay in their jobs, and it affects a huge number of the workforce. So in countries like Germany, including 20% of the workforce on being such job retention programs. Now I want to come to the corporate sector, and this is an important issue. The crisis limits the ability of many corporates to invest because revenues have been drying up. Many of the obligations, liabilities are still present. So we see quite a sharp increase in corporate leverage. On the left-hand side, you see this total debt of non-financial corporations relative to GDP. In different Western countries, you have a huge heterogeneity. I found that quite interesting to see. If you look at Germany, Germany actually has relatively low, 100% non-financial corporation debt to GDP ratio. If you go to some other European countries, Belgium, France, much, much higher. So, you know, this is a big issue affecting the ability of companies to invest, and you have a huge heterogeneity. On the right-hand side, you see a bit of a breakdown for 2 different sectors, accommodations, food services on the one hand, arts, entertainment, recreation on the other, and then manufacturing. So also here you see quite a bit of heterogeneity, but the key point is those sectors hit particularly hard have a relatively high ratio of debt relative to equity. So one big risk factor I think that we need to understand better and that will limit investment. If you then look at sectoral differences, not surprisingly, services are particularly hard hit by the crisis. This is now a contraction in the second and third quarter of this year relative in terms of GDP, and then broken down by sectors, and you see again services hit particularly hard. Of course, we have also significant geographic differences within countries. Some cities have been hit a lot harder. I mean, if you think of Berlin, where I'm advising the government here of how to deal with the crisis, A big plus is government sector is relatively large, so relatively stable. A big negative is you have a lot of small and medium-sized enterprises in the city, a lot of services sector enterprises related to tourism, related to arts and also smaller companies. So that makes the city particularly vulnerable, whereas cities that have a stronger industrial structure, have bigger companies, tend to be somewhat more resilient. So cities like Berlin clearly are weathering the crisis relatively well, but compared to other cities, you have different vulnerabilities. I will skip over some of the next charts to get to the end because I was supposed to limit it to 10 minutes. I think just one general point is, in a situation like this, the likelihood is quite high that we will see a significant downward pressure on prices overall. And you see this here on the left-hand side. This is inflation expectations, which have dropped very sharply in most Western countries. So United States, Euro area, and also Japan in this chart. As there is a lack of demand, this is likely to put downward pressure on prices, but you still see prices might pick up, hopefully, by 2021 with different policy packages. So let me get to the end, to the fiscal stimulus programs. As I said, you have a huge heterogeneity. It's a bit difficult to look at the different elements. Here you see that many of the programs have a very large contingent of loans and loan guarantees. So to basically, where the governments say if to give incentives to banks to keep lending, and they do this by giving out significant guarantees to banks via development banks in Germany, so through KfW, that these loans are safe. This seems to have worked relatively well. So if you look at credit to the private sector for the Euro area, of course it has declined, but not as strongly as some people had feared. So big fiscal stimulus programs. Now just a few words about the German program. The German government enacted a new program about 10 days ago, 170 billion euros. It includes a reduction in value-added tax by 3 percentage points on the regular one. It includes, apologies for this chart to be in German, but I couldn't find an English version. So, you know, the value-added tax, about 20 billion euros, cutting in other taxes and charges like energy taxes, a big reduction. There is a biggest chunk on the left is help for companies to get through the crisis. So there is a very big fiscal stimulus program, again, to stabilize the economy overall. Final word on monetary policy. I mentioned it. Central banks are under pressure to do a lot, and they have been doing a lot. I like this chart because it comes from the ECB and it shows their own inflation projections over the medium term, over the next 2 years. And basically what they say is they admit that they won't meet their price stability mandate over the next 2 years. So what I want to say with that is I am convinced that we will see continued monetary policy accommodation, and we might see additional steps. The Federal Reserve in the United States has actually now started also buying corporate bonds, and also kind of not very highly with a high rating. I think the ECB probably will have further easing measures to ensure that credit is still flowing to the private sector, and this has by and large been relatively effective. So interest rates are staying very low, also in relatively more risky countries like Italy. Equities have rallied. I mean, I think this has taken most of us by surprise to see the strength of the recovery in equity markets. So both on government, all three on government bonds, on corporate bonds, on equities, financial market developments have been very positive, also thanks to very strong monetary policy accommodation. So overall, I think there is good reason to be optimistic that we will see now recovery. We shouldn't be too optimistic in terms of the speed. It will take a long time, but governments have acted decisively, both on fiscal policy and monetary policy. And my hunch is they will continue doing this for some time to come. So I don't believe this has now been the end of fiscal stimulus that we have seen in Europe and also on monetary policy. I'm cautiously optimistic that we are now recovering with all the different heterogeneity, the risks also to the corporate sector with high debt, but financing conditions remain very, very favorable. So that keeps me modestly optimistic.
Thank you, Professor Fratzscher. Good afternoon, ladies and gentlemen. My name is Matthias Leube. I'm CEO of Colliers, and I would like to cover basically the real estate piece in this webinar in terms of presentation. So first question is whether on the real estate side, we can see any indication that Germany is really seen as a safe haven or continuously seen as a safe haven. And secondly, I would like to cover 3 asset classes, i.e. offices in detail, and then briefly go over residential and industrial logistics, those areas that are for some investors seen as very resilient in this pandemic. So let's start looking at whether Germany shows any indication of being a safe haven. And if you look at the 2020 period and the amount of transactions in the past months, we can see that Germany normally, in comparison to other countries, has something around 20% of the deals happening in the Eurozone. While since the pandemic started, we have seen that the percentage basically almost doubled, and that Germany had a much higher amount of transaction in this period. Also, if we look at the standard deviation in terms of returns, we also see that Germany compares extremely well in this context. That Germany is less volatile in comparison to any other developed country. So now going into the asset classes, looking at the office market, and this is a lot of talk about how impacted the office market could be from basically this environment of home office and also in terms of development. And we have looked at basically all the different views. So basically, let's start with the development pipeline. So up until 2022, we will see something like 6.2 million of square meters being developed. And we can see that quite a large portion of this development is basically already pre-let. In all the 7 cities, higher than 50% is pre-let. In some cities like Munich and Stuttgart, even more than 70% is pre-let. If we then look into the take-up, and we have looked at the earlier crises, and we have also to take into consideration that obviously stock has increased since, but what we have seen is that at least 2.3 million of square meters have always been let, even in the global financial crisis or on the dot-com bubble. So this is also our assumption for the 3 scenarios that we are taking in terms of vacancy rates going forward in the top 7 cities. And what we can see is we have analyzed basically 3 scenarios, i.e. fast recovery, modest recovery, slow recovery, and you know, we are more in the modest to slow recovery modus now, as we have heard from Professor Fratzscher, but still we are on average over the top 7 cities below 6%, even the negative scenario. And if we are looking basically in more detail in terms of the vacancy rates in Q1 2020, we can see that the starting point is an extremely positive starting point, and particularly in the CBDs. Yeah, so we see that basically Berlin, Stuttgart, Munich, Cologne, and Hamburg are below 3% of vacancy in the CBDs. And I think in terms of starting point, that's a very good starting point for the forecast and the outlook that we are taking, which is basically that we are not thinking that for most cities we will see a decrease in prime rents. There has been a discussion when are rents basically picking up and a rental increase is taking place, and you could basically argue that below 5% you basically don't have a decrease in rent, and below 3% you definitely could see, even in a crisis, an improved environment. So basically, in terms of outlook, in the office environment, we don't expect decreases in most of the cities. We also think that the yield compression has somewhat stopped, but will remain on the same levels. And we are expecting that overall transaction volumes in Germany will be around 60 billion this year, compared to 70 billion last year. So if we look at the other asset classes, residential, and I only picked out one slide which shows well how resilient the residential market looks like. Basically, what we can see that all top 7 cities, the rents have increased since the beginning of this year. The only exception where the cap, the state cap is working basically is Berlin. But you know, from current transactions in the market, we can already see that people are picking up even in Berlin in terms of wanting to buy residential in that market. If we now look at the logistics market, we can see that basically subject to lack of land, speculative and also general development has decreased. Further decreased is likely in terms of speculative development. We can see that the automotive sector is certainly hit, but you know, this is greatly compensated by e-commerce and everything related to it. So again, also in this asset class, we see that rents are going to be stable for the years to come, and subject to availability, because land certainly is not as available as certainly some of the logistic company would like. That could have a even positive effect going forward. So this is in a nutshell the real estate overview, and would now come back to the other 2 panelists in terms of getting their views on Germany, how it compares to other European countries, and also where they see opportunities and what their investment profile looks like. So Hubert, if you want to start and giving your perspective, how Amundi sees Germany, and maybe compare it to other European countries, that would be great. Thank you.
Thank you, Matthias. So firstly, I would like to thank you for inviting me to be part of this panel discussion. So turning to your question, from your presentation, you highlighted the strength of the German real estate market. So including the management of the pandemic. I mean, guys, you have been very powerful on that with this, new incentive package. The low volatility of all the markets, and the low vacancy. You touch base about the completion stock, which you seem to say that is under control. And that's something we have to be cautious in. So I would add an important aspect, which was before COVID-19, Germany was very attractive to invest because of the potential value creation, which was based on the potential rent growth. So we have observed that in Berlin and Frankfurt in 2019. So in my perspective, the market is very strong, very resilient, but still very pricey. And what I would like to add as well is we have already catch the potential value. So we have to be very cautious on the rent level for, I mean, the end of 2020. So I would not call this a particular bonus to all of German real estate, but a bonus for some cities when compared to other large cities in terms of potential value creation. So as you may know, Amundi, we are a long-term investor. So we are looking for secured and, let's say, stable cash flows. So of course, Germany still in our radar, and particularly some, let's say, cities like Berlin, as you mentioned. I think there is a good potential. As residential asset classes, I think there is a lag of in terms of capital, because I think Berlin has to state as a capital, so there will be attractive in that perspective. Yes, really to legitimate this capital position. And Hamburg, for me, it's one of the most attractive cities because you have a lot of diversity regarding activities. And in this city, I think we haven't seen a huge increase regarding rent level. So for me, it's a market to target, it's a city to target. And of course, Munich, because it's a larger one, so it's very liquid and very strong. Regarding asset classes, I mean, we are familiar with all asset classes, but again, offices would be our preference because it's very resilient. But again, it depends how companies will recover and what would be the working from home impact in, I mean, company management, I would say. We are attracting by logistics as well, because of the online, I mean, businesses development, and as mentioned before, residential. So I can add something regarding our strategy. So we have done during COVID some transactions. So we are very active, even, I mean, it's not that easy in such unprecedented crisis period. We have invested in France, of course, in Spain, in Poland, and in Germany. So we did that, I would say, we start beginning of November, and we sign and close deals during 2020 first quarter, and even now we are still in some discussions. So I think it's time for us to have a pause, to observe, to assess what really would be the impact on the economy and finally in the real estate market. The impact of the COVID. So for us, it doesn't mean we are not investing. It means we have to be more selective as usual again, and to continue to consider the most attractive opportunity that we can get in order to deliver the expected return to our final clients. So of course, I think they will have some repricing. I couldn't give you figures because I think it's quite pretentious and difficult to assess. But I think the key point, it's really to be focused on the rent level, because that's really connected to how the companies will react, or how sustainable are the companies, so how they will be able to pay the rent, which is, I mean, really the main aspect of our sector, of of the way that we are of how we are managing our portfolio or our funds under management. That's really important. So I wouldn't give you any kind of figures, but what I know that there is a repricing ongoing. How big would be, it depends on which sectors. What we can say in offices, it could be, let's say, slightly small. And you can see it in your presentation because you only touch base offices, residential, and logistics. So I think that would be the more resilient asset classes. And the two others, hospitality and retail, I think they will have to face quite difficult period, but in the same time, you could have some opportunities. So the thing is just too good to be more selective. And I still believe on that market, and specifically in the German market, I think it could be a very good market to have again in the scope and to target for our investment in the future.
Okay, thank you, Hubert. Ali, your view on Germany, maybe also comparing it, maybe covering also asset classes. What we see is, and you covered, Hubert, you covered retail as more volatile. What we see is that within retail we see food anchored and also retail parks to be quite resilient in this segment. Maybe you want to cover, again, how you see Germany in comparison to other European countries, and obviously risk return and also asset classes. That would be great. Thank you.
Yeah, absolutely. So in terms of Germany, it continues, I would say, to be a more attractive investment environment, and specifically also for core investors like Amundi. Obviously, going into the crisis, from a macro point of view, they were probably in the best state among all the larger European economies. But as Professor Fratzscher also mentioned, the amount of economic stimulus that they were, as a result of being a more healthy economy, they were able to put so much more stimulus into the economy that we expect that outperformance to continue. I mean, some of the numbers from the McKinsey study that I've read over the weekend are really staggering, because Germany, the economic stimulus, including, I think, the guarantees, is about 33% of their GDP, compared to the next highest country, which is France, at less than 15%. So there is a lot of help that the German corporates, German consumers, and German occupiers, most importantly for us, are getting from the government. And therefore, I think we continue to expect Germany to outperform from a macro point of view. And we think that would also be followed by core investors actually even focusing more into the German market. Because in a time of crisis, when there is a lot of uncertainty in your underwriting, like your rental underwriting, etc., what happens is you try to take less risk, and less risk means less occupational risk, less risk with the macroeconomy. So we expect actually the amount of capital that is allocated to Germany by core investors would go up. And that's generally a good environment for our business model. Like Tristan, all the value-add investors are in the market to buy assets. We buy impaired assets, assets that have low vaults, the assets that require refurbishment, and then we fix that impairment, and then we try to sell it to longer-term core investors. And we expect Germany to be continue to be a good market for that, because there is more and more core investors. The allocations of core investors into Germany is going to go up. That will, I think, provide a floor for core real estate pricing, while we can hopefully, going forward with a little bit more distress in the economy and on the occupier side, but also risk aversion, we will be able to charge a higher margin for fixing those impairments and selling to the core investors. In terms of our investment activity, we have been, as you can imagine, we've been quite, I would say, opportunistic throughout the lockdown period. We have done 4 or 5 different transactions. They were all transactions that were already in due diligence, and they were all transactions whereby we actually managed to negotiate the price on an asset level basis somewhere between 10 to 15% because of what's going on as a result of the lockdowns. Now, I would say that not every vendor obviously is happy to give that kind of discount. What we have seen is all the transactions that we managed to close were effectively investors that have had other commitments and needed to close this transaction in order to pay the commitments that they have made. So what we're seeing going forward increasingly is also that the bid-ask spread as a result between the vendors and the buyers, especially buyers of value-add real estate, is going up. So the vendors believe that tomorrow it would be the same as pre-COVID, and therefore a 3-5% discount is a great discount to incentivize us to buy. And frankly, we're not sure if it's 10% or 15% because it's so difficult to underwrite in this kind of economic environment. So we have done 5 transactions, and we've invested quite a decent amount of money, maybe not at our run rate, but quite a decent amount of money. But I actually expect that to a little bit tail off in the next coming months until the 4th quarter or so. And thereafter, maybe the occupational distress will help a little bit, or maybe financial distress, if there is any with the banks, will help to close that bid-ask spread between vendors and buyers. We have been active, as you can imagine. I think all the asset classes effectively you have mentioned we have been active in. So we have acquired actually during COVID a residential portfolio in Rotterdam. We have forward purchased another residential project in Copenhagen. So residential continues to be an important theme, I think, in terms of diversification for our funds, but also there is, I would say, a great rotation for end investors in terms of their portfolios. If you look at an end investor's historical portfolio, it was really 40% offices, 40% retail, and 20% alternatives. I think alternatives included residential as well as logistics. And that 40% of retail is really going down to maybe maximum 20%, and alternatives is going from 20 to 40. So we feel, you know, whatever you do, even if you don't have the best selection, there is so much more capital markets interest in residential and logistics, and there is a lot less interest in retail, that effectively the tailwinds would continue to help. So we have been investing at residential in different parts. Also logistics, we have acquired some logistics in Spain during COVID, actually at the beginning of March. We are also in the process of acquiring some more logistics to our platform in the Netherlands. And we see that once or twice, maybe a little bit with the developers, there are good opportunities because developers have really made their business plans to perfection. You know, the assets are built on time, they are let before they are delivered, and they are sold to Amundi without the need for, let's say, our transitional capital. And in this kind of environment where there is a set of, I would say, speed bumps in the economy, that business plan fails, and that's usually a good opportunity for investors like us to step in. And we have seen that on the logistics front as well. And then we have also actually acquired one asset in Germany, which is a little bit of a controversial because it's a retail park. Not that we have a great insight into the retail world and which types of retail assets will have more longevity, will survive, and which types will die. I think we definitely want to stand away from that discussion. So we have been very selective in terms of buying retail. But in this case, we have both actually a Berlin retail park, which is on the public transports. It's close to the inner city, and there is a lot of alternative use value if you can convert it to residential. So our business plan is not that, you know, we believe that retail cap rates are high and therefore we're going to make money through that, but we're planning to effectively develop a residential project there over a period of time, and that's how we're planning to make money in retail. I think offices, obviously offices is the largest asset class if you look at commercial real estate volumes. So if you're a pan-European investor, investing and taking a diverse exposure, you cannot just avoid investing in offices. Obviously, there is a whole discussion about the future of the offices. Will we need more space? Will we need less space? Will we need it in the city centers? But then you have to take public transport, or will we need it in the suburbs so that you can come with your car? I think all of those are valid discussions, but a little bit, a part of me feels like all of those discussions in different crises were already had. You know, after 9/11, nobody was going to rent offices on the 60th floor, and nobody was going to pay those rents because we all wanted to be in 3-story offices. And we have seen that a lot of those effectively almost melt away as these crises melt away as well. I think if the human propensity was any other way, they would have the way our offices are structured, our homes are structured would have been different. So we still continue to believe in the office product. And as you have actually very rightly pointed out, we entered into the crisis from a pretty good point of view, both in terms of vacancy, and also one thing missing, I think, in the discussion was the development pipeline. So the development pipeline across all major office markets is about, over the next 4 or 5 years, is about 5% of the existing stock. And that's very much in line with, if you look at 10, 20-year net absorption levels, it's very much in line with that. And that's true for, as you put out, or for nearly all of the German big 7 cities, but it's also true even if you look at Paris, it's true, if you look at Madrid, it's true, if you look at Amsterdam, it's true. So most of the European capitals actually have entered into the crisis with low vacancy in the office sector and with a rather manageable development pipeline, with the exception of 1 or 2, I would say, segregated cities. So therefore, I think offices, logistics, and residential will continue to be the main focus of our investment activity, which we hope will pick up, because we genuinely believe that these types of dislocations in the market are good opportunities for us to be charging a higher margin for our buy, fix, and sell business.
Thank you, Ali. Thank you, Hubert, and thank you, Ali. I think I can confirm, and Giuliani, if you want to join us for questions, I can confirm that in this crisis, we are starting to see that risk is priced again. Yeah, I would say, but on the other hand, you know, core from our perspective, also in terms of what we have in the market, we see that there is a continued interest in core product across those asset classes we discussed, and you know, I can only resonate what both of you said. Juliana, do you want to dive into questions?
Sure, certainly. You already briefly touched on one of the questions that entered the discussion at the beginning. What is your view on the resilience of rental income and yields for food-anchored and DIY retail assets in Germany? Are you considering further retail park investments? So both of you have already done rough statements on retail as an asset class in general, but on that precise question, would you consider? Mr. Otmar, you already dived into that. Maybe can I hand over the question to you first?
Yeah, absolutely. Look, I think, as I mentioned, I feel like even if you're the greatest asset manager in the world and you buy I'm going to take the most extreme example, a shopping center, and you turn it around, the capital markets tide is going to be against you, because all the end investors are rotating out of retail. So as a result, even if you manage to stabilize the rent roll, even if you manage to actually increase the rent roll, I think you will lose whatever you're winning in the capital markets when you sell the asset. So as a result, we're really very selective on the retail front. Obviously, retail parks, which provide a lower capital value and a lower rents, are more attractive. And a lot of times, like the one we have invested, are actually in locations where there is a lot of alternative use if the retail story were to fail. So we are effectively only looking, I would say, things that are well located, low capital value, and actually with the rates where they are, you can finance them still pretty well and get a very good cash-on-cash return while you are almost waiting and working on your alternative use business plan.
Yeah.
Thank you. Mr. Joachim, how is your perspective on the question?
Well, as I said before, we are more focused on co-investment. So it doesn't mean we are not looking at retail again. We are more focused on high street retail. Retail park is something we can touch, but again, we are very selective regarding the location, of course, and we are pretty happy to have a look on new property because we are not a developer, we are not doing refurbishment and so on. So the property should be well located and deliver secured cash flow in order to have a good cash flow behind with financing. That's something we can consider, but that is not the most important or most popular, let's say, asset class in our portfolio. So regarding retail, we are not limited, I would say, but we are looking at high street retail. We had some shopping centers and retail park, really a few.
Right. Okay. Thanks.
But I believe there is an angle maybe to make money in that particular asset classes. But again, as Ali said, you have really to be very selective again.
It seems that that is the line, really, the red thread through all developments right now. How do you see, another participant is asking, leverage being available?
Ali, it's probably your question because I think
yeah, we do take quite a bit of it. So I think in our case, we have two products, a core plus product, which takes about 45% leverage, and a value add product that takes about 65% leverage. I can tell you that the maybe margin widening in the 45% was rather limited, and there is still ample opportunities, ample banks competing for assets. Obviously, they're more selective, and sometimes lot size could be an issue. If you're trying to finance a 300 million building, it's definitely more difficult than if you're trying to finance a 100 million building. With regards to the, I think, slightly higher leverages, 65% and so on, I think there is the dislocation is definitely greater. So the margin widening is more, and then the market is much shallower compared to, let's say, 45% financing. Having said that, again, I think in Germany, probably there is the best situation for the financing market as well. I think if you come to the UK, for example, the widening is probably in the 200 to 300 basis point range at that level. Whereas I think in Germany, the widening is probably at the 50 to 75 basis points range. And the good news is, I think we now expect, together with the rest of the world, I think, ultra low rates for a period of time. So the base rates have kind of taken away a little bit of that margin widening. But more importantly, I think in our projections, which is generally we invest for 3, 4, 5 years, you can actually assume a similar interest rate environment, which wasn't the case maybe even before at the beginning of this year.
Right, I have another question which seems to come out of self-reflection maybe. One participant is asking, how important are the investment brokers during the next years? Will there be any difference in comparison to prior COVID-19?
Maybe so, I start. I think certainly for us, the environment is also challenging. Yeah, certainly, because I think everyone has moved ahead maybe 5 or 6 years in terms of digitalization, because we all made an experience in terms of working digitally. Yeah, and certainly also in our industry, in our area, this will have an impact. Yeah, and I think this is part of, I think, also these webinars in terms of how the world is changing in terms of exchanging views in this environment. So generally that has an impact, but you know, obviously Ali, Hubert, you want to share your views on this as well?
Yeah, sure. I think in the market you have different players. So I think agent will have their role to play. Actually, because we are an investor, we don't have, big database. And you do need to have this in order to do your underwriting, in order to have comparables, and you need as well the agent in order to connect people. Even you can do it in your own, but I think they have a bigger, large scale to help us on that. And I think what would be challenging as well is just to assess and try to evaluate what would be, let's say, the pricing regarding rent and cap rate. So I believe they probably will have a change on the way to do business, but I think all the players will have to stay in and make it happen and give us a clear view, or at least to help us to have a clear view in our investments.
I think it's similar. It's a pretty broad question, but at the end, we're fiduciaries, and it's not our personal money, but it's our investors' money, and therefore we have to go through a process, and we need kind of to choose the best people that maximizes the proceeds from that process, and therefore we would continue to be working with brokers. I don't see how that can change.
Right, there is another question that just came in. Do you see rental growth rather flat in the next 1 to 2 years, or will there be growth? And if so, in what cities do you expect rental growth? I suppose we could ideally give a round of everyone pointing out their favorite cities. So what would be your investor's darling?
Let's start with Professor Fratzscher, maybe.
Yeah.
Well, my favorite city obviously is Berlin, because I'm living there, but obviously I'm more a macroeconomist, so for me it's a bit harder to have the understanding, or I don't have the understanding as the other three panelists. But to me, from a macroeconomic point of view, clearly it's always the question which one relevant element is always which economy or which part of the economy is recovering more quickly. How will the big cities do in terms of the economic recovery? So in that sense, as I said in my talk very briefly, I think Berlin is probably struggling a little bit more with the crisis because it has a lot of small and medium-sized enterprises. It's more dependent on services. But as I also showed in my projections, we do see Germany as getting through the crisis better than most other countries. So actually, it's a very difficult one to pick a city, but I would be equally optimistic about the German cities. But I liked what Mr. Leube said on the comparison. For me, that was very interesting. So I tend to be optimistic, as I said, cautiously optimistic for all the cities considered.
On my side, I mean, it's quite difficult as well to choose a city. I would say Paris, but I think it would be a mix of different cities. And again, I think the key point, the driver is the economy. So which sector would be more resilient during this crisis or after the crisis? So I think that would be drive. I mean, the rental, the increase, also potential growth of the rents. So actually, we have seen a lot of it would be maybe services or logistics or manufacturing. So it's quite difficult to say, but I will choose Hamburg for, I mean, the diversity of the activity. And even regarding logistics, is not this harbor, but Bremen. But I believe Hamburg, it could be my favorite cities, and Paris, because it's very diverse as well, and it's very big cities with big volume. It's very deep, strong. So that would be my two favorite cities.
Thank you. How about you, Mr. Otmar?
Well, the answer for us is usually very easy. I don't know, so I'm not going to bet on it, right? So the way we think about it is we don't really know, because we don't know how the occupier will react to it. And therefore, when we underwrite, we cannot rely on that in order to generate our base case return. If it happens, great. If it doesn't happen, it couldn't be forming a major part of our judgment with regards to a particular investment. I think some of the things Hubert has mentioned is right. Obviously, Berlin has more, let's say, .com type industries, and in this kind of environment, when people are more worried about risk, I think there will be less capital available to those sorts of businesses, which draw, I think, a lot of the rental values in Berlin. So that's something to be careful of. But on the flip side, if you look at Stuttgart or some parts of Munich, they're also heavily automotive industries. And that part is also, even before the crisis, I think if COVID didn't happen, we would have been discussing on this panel what's happening with the German automotive industry. So as a result, that's, I think, also another consideration. When there are so many unknown variables, I think the easiest decision is not to bet on it.
Yeah.
Yes, especially when it's concerning Stuttgart, because innovation hubs like that city come up with new technologies like biotech. We've had a recent buy from the government of Germany in CureVac, which has been highly vetted by the American president, as we all know. But let me hand over to Mr. Leube to actually your favorite city and maybe a wrap up, as we always do, just prior to 3 p.m.
Yes.
We have 2 more further questions that we can address afterwards, but for everyone who wants to log out in time, just a quick wrap up from your side.
Yes. So first, covering on my favorite city, I think I'm more down from my history in terms of also working on the investment side as an investment manager. I'm more in terms of it depends on basically, as Ali said, on the investment opportunity. Yeah. If you then look at the macro level on the cities in particular, I think some cities are more affected to some industries, as we just covered in terms of automotive. But if you look at the outset, you know, in terms of vacancies, particularly in Stuttgart and in Munich, this is extremely low, even in the worst case scenario. And for example, in Stuttgart, we currently have like 4 really big searches on the office side. That is about 50 to 60,000 square meters. Yeah, so you have that kind of perception in terms of Munich and Stuttgart being so much affected by automotive, but effectively it's not really. So it really depends on what you have in terms of setup, and also in terms of how resilient the other sectors are in that particular city. Yeah? So personally, I think it depends on your investment strategy, where you want to invest. Obviously, Munich is a very diverse city. Hamburg, as Hubert said, is a very diverse city in terms of sectors. But Düsseldorf and Frankfurt provide a lot of opportunity, I think, in this kind of environment because of the setup. Yeah. So I think I would also have difficulties to pick a city because this environment provides different opportunities as such. So in terms of wrap up, I think what we heard so far is that obviously we have significant impact by this pandemic. Germany, in a sense, and that's my take, was lucky with some of the management it took, but now did some really good moves in terms of financial stimulus. I think the outset in terms of the asset classes in real estate is very positive. Yeah, and even in a worst case scenario, it looks as if that the markets and most of the asset classes are pretty resilient. So Germany is, from my perspective, pretty interesting, also in terms of what Ali and Hubert said. So I think whether there is a bonus or not, I think there's a certain attraction to Germany with basically its setup. Yeah. You really need to dive a little bit into detail, because it's not just one city; it's more than that, and certainly then understanding the opportunity is the challenge that a lot of the international and also local investors have. And I think the outlook is positive for the market. So if you want to cover the other 2 questions, then maybe we can do the final wrap up.
Sure. So one question was addressed to Mr. Otmar. It was concerning potential discounts that you might have received in deals while the shutdown. Do you think that was based on lower office rent estimations, as you mentioned, or is it the fast closing? What is the core reason for that development?
Sorry, I was on mute. Obviously, our underwriting criteria has changed, so we have increased void periods. We have gotten rid of rental growth, and we have also assumed a little bit softening in the exit cap rates. So it was a confluence of different factors. I would say that the direct result is we probably have received, if our pre-COVID underwriting was applied to the same prices, we would have had 200 basis points or so higher returns across the different investments we have made.
Right, thank you for that insight. There's another rather broad question, so maybe from your sides, a quick answer on which challenges and opportunities will the acceleration of digitalization add to the market challenges? Would you like to respond, Mr. Joachim, just to take in how valuable is digitalization for the processes, and do you think it will accelerate market procedures considerably?
So we have seen during this period, this COVID period, I mean, digitalization has been used, especially for site inspections and to do some due diligence, or to have a conversation, meeting, and so on. So I think that will stay, but partially, because I believe we are in a sector that we need to see and to talk and to inspect. So it will have its place, but I would say communication and physical presence is important as well.
Well, that's reassuring as an organizer of events. Right, well, so I've had two more questions on the topic of a few numbers that Mr. Fratzscher provided, but I can respond confidently to that we will have the slides available for you online, so you can download the presentation and then access the accurate numbers in the fact check after this webinar. So thank you for that. And then if it's all right for everyone, I will quickly wrap our session up, and let me first of all thank you all for this very intriguing conversation. It's been a pleasure, and yeah, we would love to have you in a different setting nearer to time, like we mentioned with Mr. Joachim, to be present, to talk with each other. I think this is very valuable and advances your business as much as ours. Let me say thank you to all our participants as well for your questions and your time and interest. We hope that you could take much information away, and yeah, let's stay all happy and healthy. That's what's counting most, and positive on the market outlooks. Thank you all very much. Bye.
Thank you very much.
Bye.